Good news, friends! The One Big and Beautiful Bill has been signed, which means you no longer need to worry about the federal estate tax exemption limit being cut in half. This video is about the new federal estate tax exemption limit and also a reminder to still be vigilant despite the good news. You see, estate planning is more than just about avoiding the federal estate tax. There are other taxes that we need to stay on top of. All right, let's dive in. Let's start with the federal estate tax exemption limit. It was supposed to sunset at the end of this year. That means the almost $14 million in exemption limit would be cut in half to around 7 million. Now that would affect a lot more families. Think about your circle of friends. For me, I don't know many families who have over $14 million in total assets. But I do know many more families who have more than half of that. So if this sunset did happen, those families would have to scramble because now they'll have to pay estate taxes, federal estate taxes. Fortunately, not only did the cut not happen, so no cuts, but the limit actually was increased to $15 million in 2026. And beyond that, it will continue to increase, adjusting for inflation. So that's really good news. That makes estate planning a lot simpler. You know, about 20 years ago, this limit was as low as $600,000. And in fact, only 10 years ago, it was just $1 million, which means any asset above $1 million would be subjected to the estate tax. So there was a lot of complicated planning. An example is the A and B trust that is designed to minimize this estate tax. However, comparing to the $1 million limit and the $15 million limit we will have next year, a lot of these complicated strategies don't have any use anymore. Estate planning can be a lot simpler. Also note that this change is a permanent change. The big news about no taxes on tips or no taxes on overtime pay. These are wonderful tax cuts. However, they will expire at the end of 2028 by default. Not so with the estate tax exemption limit. It is a permanent change, you know, as permanent as things can be in our environment. In addition, there were many tax provisions that were very controversial that a lot of politicians wanted cut that did not get cut. And these tax provisions allow us to continue employing great estate planning tax strategies. An example is the step up in cost basis. What this is if you inherit your asset, for example, your home, to your children, the cost basis of your home will step up to the current market value at your death. So if they choose to sell your home the next day, they pay zero capital gains tax because the cost basis of the home stepped up. In 2017, income tax brackets were reduced, and this reduction was supposed to sunset at the end of this year, 2025. But with the big, beautiful bill being signed, the current tax brackets will not change. It will stay the reduced tax brackets that were introduced in 2017. That's really good news. For example, if you're considering an IRA to Roth conversion, the tax brackets today remain the same discounted tax brackets that were introduced in 2017. I am glad that I'm able to continue converting my IRA into Roth using today's discounted tax brackets. Capital gains tax today maxes at 20%. And a lot of people predict that this will be increased, but no, it did not get increased. The maximum capital gains tax you can be charged today remains at 20%. This is helpful for when I need to withdraw money from my taxable accounts, my taxable investment accounts. If I need to withdraw money from those accounts to pay for my IRA to Roth conversion, because they're taxable accounts, I will have to pay a capital gains tax on it. And I'm glad that the maximum is still only 20%. Another tax provision worth mentioning is the 1031 exchange. It did not get cut. This allows you to trade up your rental properties to bigger and bigger value properties without paying the capital gains tax when you trade your rental property to another rental property of higher value. You continue deferring capital gains tax as you trade up your rental properties to those of higher and higher value. And then when you hand it down to your children, the total deferred capital gains tax gets wiped out because of the step up in cost basis tax provision. This is a very popular strategy that very wealthy families use to create generational wealth. So there's a lot of good news, right? However, I want to remind you that there is another estate tax that can be imposed on you. It's not the federal estate tax, it's the state estate tax. Does your state impose an estate tax? If your state is one of the blue states I'm showing on this map, then yes, it does. If your state is one of the brown states shown on this map, then it imposes an inheritance tax, which I'll talk later. Let's just talk a little bit about the state estate tax. It really varies state by state. For example, I live in Massachusetts, and in my state, the limit, the threshold for exemption on the state estate tax is a low $2 million. So if my total estate is $8 million, for example, I will pay zero federal estate tax because it's not even anywhere close to the 15 million exemption limit. However, since my state imposes an estate tax on anything above $2 million, that will be quite a chunk of money due from my estate when I pass away. Other states, like Connecticut, has a very high limit. It's the same as the federal, so it's over $10 million. So anything under $10 million, if I live in Connecticut, I will pay zero state estate tax. I don't know. Connecticut is just next door to Massachusetts. Maybe I'll move there to avoid the estate tax from my state. Now let's talk about the state inheritance tax. So let's be clear. The estate tax is imposed on the estate. The person who passed away, his or her estate pays that tax. The inheritance tax is paid by your heirs, by the folks receiving the inheritance, your children, your nieces, nephews, and so on. So the inheritance tax is only imposed by a few states. Here's the list of the states. You can forget about Iowa because that state inheritance tax will phase out entirely at the end of this year. And for these other states, if you are the spouse or the child of the person who passed away, the inheritance tax is also waived, except in Pennsylvania. So while the federal estate tax exemption limit is very high, don't fall asleep on the wheel. You still need to think about the state level estate tax And if you live in one of these 5 states and you're not a spouse or a child of a person that you're inheriting any money from, then you'll need to also worry about the state inheritance tax. I also want to mention the IRA tax time bomb. Your IRA has an IOU to Uncle Sam because you built it up from pre-tax dollars. Now it's time to pay the piper. Every dollar of IRA that you withdraw, you will have to give a portion of it to Uncle Sam because it will be taxed as personal income. So if your IRA account statement says you have $1 million, you don't really have $1 million. You have about 2/3 of that, okay? Unlike the Roth IRA, the Roth IRA is built from after-tax dollars. So every withdrawal from a Roth IRA is tax-free. Unfortunately, the traditional IRA is the much bigger account. In fact, for many families, other than their primary home, it's their biggest assets. A lot of families think, well, I will just take the minimum required distribution when I turn 73 years old, and if I don't use it up, I will just pass it down to my children. That is actually not the best solution for a lot of families. Think about it. If I pass away at age, 80, 90, my kids will be in their 50s, in their late 50s, and usually that's someone's peak earning years, which means they'll be in a higher tax bracket than I am right now, because I'm retired and because, as I mentioned, I believe that today's tax brackets are actually discounted tax brackets and will not continue very long. So by passing your inherited IRA to your children, you're just kicking the can down the road and creating a bigger problem because they will have to pay higher taxes on the IRA. Not to mention there are a lot of rules such as having to take out minimum distribution from the IRA and having to drain it by 10 years, et cetera, et cetera. I have a video that I made about the inherited IRA tax bomb. I will definitely leave a link below this video so you can have a deeper dive into it, okay? This here is not a tax per se, but it could take a big bite of your estate. What is it? It is not making sure that your estate does not go through probate. Probate can cost 5 to 10% of your estate. Just the professionals that you need to recruit and get involved. If you have family disputing the value of certain assets and the fairness of things, it could cost a lot more. You may need to involve even more professionals. In addition, there are administration fees, court fees. Did you know that every copy you need to make with a court document gets charged? By all means, avoid probate.
A quick summary. So you can now ignore all those videos and warnings about the federal estate tax exemption limit being cut in half. Not only did it escape the cut, it got increased to $15 million in 2026. But don't get complacent and ignore the other taxes that can take a bite of your estate, such as the state estate tax, the state inheritance tax, and the hidden IOU inside your traditional IRA accounts. And by all means, avoid probate. Earlier in the video, I mentioned that I created a video on the inherited IRA tax bomb. You can find the link here right now. And that video will not only help you understand the issue deeper, but also gives you actionable items, actions that you can take to avoid passing this burden of the IOU tax to your children.